Is house price growth just keep on going, and just how overvalued is it? Could there be a correction looming given the run-up in the harbour city and Melbourne? Are there any signs of a bottom yet in Perth and Darwin, and will interest rates go up or down this year? These are just some of the questions property observers are asking themselves as we really get back to business in 2017. We've assembled two experts who know the market inside out to tell us what they think will happen this year. They are Louis Christopher, the founder and managing director of SQM Research, and Doug Driscoll, the CEO of real estate group Starr Partners. It's fantastic to have you both here. Thank you so much.
Good to be here.
I guess let's talk the national market, a broad sort of brush of what you're seeing at the moment. I mean, the figures, the latest figures from CoreLogic certainly seem to be showing overall that sort of momentum going. Narrowing it down to Sydney, though, it's just streets apart, isn't it? The growth that's continued happening there.
I must say, nationally, it is actually a mixed market. And the aggregated numbers that you see published by a number of data providers, including ourselves, are really dominated by what's been happening in Sydney and Melbourne. Of course, they are Australia's two largest capital cities, so you would expect that. But when you actually split the numbers down, you see actually some weakness in some cities, namely, for example, Perth and Darwin, and to a lesser extent Adelaide. You definitely see strength in Sydney and Melbourne, but then again, when we look at Brisbane, it's a bit of a mixed market there, with units not doing so well. And then you have some up-and-comers, effectively. For example, Hobart seems to be accelerating. So it is a mixed market nationally, and we've got to be careful about allowing what's happening in Sydney and Melbourne, assuming that's happening everywhere. It clearly isn't.
Yeah. Just on Sydney, Doug, are you noticing any slowing at all as we're going into this start of the year?
Not at all. It's the rise of Sydney. Obviously, look, we've experienced a phenomenal last 2 years. We've seen perhaps 30% growth across Sydney as a whole, and the early signs are that will continue. There's no reason why it'll abate, and there's certainly no obvious catalysts to stop that momentum.
What's your prediction for growth this year?
Crystal ball time, but if I was a gambling man, I would certainly say we'd be approaching, if not exceeding, double digits again.
Again in Sydney?
Yeah.
Yeah. And your forecasts, have they changed at all from the boom and bust report?
No, they haven't changed. So we're becoming increasingly confident that our 11 to 16% forecast for Sydney will come in again this year. It's going to be a very strong start to the year. We'll get a bit of an idea today. There's 200 auctions in Sydney today, and we're looking to see a clearance rate of at least in the 60s. But yeah, no, we're pretty confident that that's how it's going to play out for this year. A very strong first half of the year. Potentially a little bit weaker in the second half of the year. We'll see. It much depends on what interest rates do, whether we see any government intervention in the marketplace. And then 2018, well, yeah, that could be an interesting year.
What do you think? I mean, there's talk maybe of APRA putting in more regulations to try and, again, restrict investor activity. I mean, do you see that happening? Can the RBA do anything to sort of slow down?
Yeah, well, really, I mean, they can come up with all types of things to slow the market down if they really want to. I think they're being cautious now, and the Reserve Bank of Australia has to consider more than just the Sydney and Melbourne housing markets in terms of determining monetary policy. That said, though, we are aware that investor credit growth is starting to accelerate again. And in the past, whenever investor credit growth has gone beyond 10% per annum, APRA and the Reserve Bank of Australia have taken action. They don't like seeing going over 10% per annum. At the moment, that rate has now risen from about 5% up to about 7.5%, 8%. And I think it will accelerate this year. So there is actually a likelihood of APRA coming into the market later this year, taking further action, which could be, for example, forcing investors to put down an even larger deposit on a home.
Is that what you're sort of predicting as well? What's your sort of forecast, do you think, for lenders, what they're going to be doing as well when it comes to investors?
Well, I certainly think it's a very complex issue, and it's not one that's going to be solved overnight. And I think if you look at any intervention, whether it be the RBA, federal government, APRA, it is a very localised matter, as Louis alluded to. It is really a Sydney and Melbourne problem. So any intervention, any changes are going to potentially have wide-felt ramifications elsewhere. So it has to be a very localised thing. In regards to sort of moving forward, I think actually, ironically, it could be the banks that could end up solving the problem. For a long time, they've been lambasted or chastised in regards to their greed and constantly putting rates up, irrespective of the RBA's movements. And I think that's certainly what we're going to see this year. And I think they'll be quite aggressive in their upward movements. And that may well start to put the brakes on the market. So there is a sense of irony there. As to whether it plays out, well, we'll soon find out, I'm sure.
Yeah, and because you are quite concerned about the levels of investors in the market compared to owner-occupiers in some areas of Sydney?
Yeah, well, I mean, across Sydney at the moment, certainly over the last 3 to 6 months, pretty much half of all properties are selling to investors. I personally don't believe that's a healthy mix. In a typical market, or whatever that may be, I would certainly say it's probably 25 to 30%. And the issue with too many investors is really twofold. Firstly, you're leaving numerous owner-occupiers on the sidelines, and you're also seeing then that properties are being held for longer periods of time. So typically, the average owner-occupier would move home about every 11 years. Investors, when they acquire property, they have a far longer-term view. So property is being held for longer and not then seeing the light of day.
Lou, what's your view then on interest rates, or does it really matter? Is it, what the lenders do, because they're going independently anyway, and what's the risk of a correction, do you think?
They are to an extent, but the Reserve Bank of Australia still has heavy influence on retail rate setting in the country. There's no question about that. If the Reserve Bank of Australia were to lift rates tomorrow, believe me, all the lenders would lift rates too. When we look at what the money markets are suggesting for forward interest rate movements, there is an expectation in the markets now that interest rates will rise sometime first half of 2018. So that is something that's being forecast out by the money markets, and they generally get it right. So, and that's one thing that's probably changed in the past 5 years. Generally speaking, over the past 5 years, money markets have been forecasting rate cuts and more rate cuts, and that's how it's played out. So now what we call the yield curve is actually now reversed, and it's now forecasting a rate rise. It's very unlikely that's going to happen this year unless something surprising happens in the economy. For example, global commodity prices go gangbusters, and that creates a surprising effect upon national GDP. For now, no interest rate rises this year, but just watch for the banks perhaps lifting their fixed rates further in anticipation for that rate rise in 2018.
Yeah. Just want to ask you too, Doug, because you have got your list of top 10 suburbs to watch for Sydney for 2017. We've just got them here. If you could just quickly take us through Blacktown, number 1 on your list.
Yeah, look, Blacktown had a fantastic 2016. It really came into its own. There's a lot of money being invested there. There are numerous new homes being built. Obviously, it's smack bang on top of the M2. It's got a good rail network as well. I also think it's undervalued by comparison. And we recently sold the most expensive property in Blacktown, and it was only a smidgen over $1 million. And when you think about the median price across Sydney, I think that represents fantastic value for money. So I think, as I said, it's only coming into its own, and it'll only get better.
We're just looking at some of the others. Any sort of common theme between your top 10? At all?
Normally it's infrastructure. There's 2 or 3 there which centre around the likes of Badgerys Creek. Obviously Liverpool, I believe, will be sort of a commercial epicentre as a result of that. It will perhaps become Sydney's 3rd CBD, if you like. There are areas to the south as well which naturally will benefit as well.
Yeah. Just looking at Sydney and also Melbourne, you did warn in the boom and bust report you put out late last year of, signs of a bubble. I mean, up so much in such a short space of time.
Yes.
And with this further growth that you're both predicting.
Yeah, the market is overvalued now. It's beginning to, if our forecasts come in for Sydney and Melbourne, and the forecast for Melbourne is 10 to 15% for this year, then by the end of this year, both markets will be dangerously overvalued. Melbourne is already at a record overvaluation on our numbers. Sydney is at its most overvalued point, except for 2003, when it was rather overvalued then, and then we went into a period of stagnation and some falling prices. So, yeah, the markets are definitely overvalued, and the problem with that, of course, is that the trigger required to create the next downturn will be less and less. Instead of having, say, interest rates going up 2%, we may only require interest rates to go up 0.5%, and that's the trigger. That's what creates a downturn. Yeah. Just the more overstretched the markets become, the less is required to create that downturn.
quickly just looking at some of the other trends perhaps of this year. I mean, the lack of listings has just continued so far. Do you think that's going to continue to be an issue that's just driving up the competition for the properties that are around?
Absolutely. Again, as Louis alluded to, it's artificially inflated. You know, obviously there is a chronic undersupply of property at the moment. If you're a seller, you're definitely going to get top dollar. The problem is, of course, is the likelihood you're going to have to move somewhere else. So it is swings and roundabouts. But again, that's a lot to do with the investor boom. Investors are holding properties for longer. It's very difficult then. But again, I just don't see that changing.
Louis, could you give us your national roundup then of some of the other major capital cities? Because Hobart's been a great performer, hasn't it? Perth and Darwin, though, at the bottom. Yeah,
so Hobart is definitely accelerating now. The bottom in Hobart really came in about 2013, 2014. And that happened for a number of reasons why we had a bottom. Firstly, we had a state government that came in and really started doing the right things economically. And that's helped the state. The lower Australian dollar always helps Tasmania, being more of an export-focused economy there. And an increase in ecotourism has also helped the state, as well as lower housing prices. I mean, Tasmania's got the most affordable housing in the country by far. And so all that has created interest in the market. And with an increase in population growth, and there has been a little bit of an increase after years of basically people leaving the state. That's reversed now. People are coming to the state finally. We're seeing vacancy rates now falling right away, particularly in Hobart. So we're recording vacancy rates now of under 1% in the Hobart market. Rents are now rising by about 6% per annum in that city. And yet property yield, so the yield you will receive if you buy a property in Hobart, is still around circa 6%, which is a pretty good rate for residential. So all those factors are creating interest in that Hobart market. Our forecast is that Hobart prices will rise between about 7 to 11% this year, and that's looking very much on track. So on the other hand, though, when we jump to Perth, prices are still falling, and Darwin as well. Naturally, they've been affected by the commodities downturn for a number of years now. But there is evidence that a bottom is coming. Indeed, we're already seeing a bottom in some of the mining towns, such as Karratha, where we're finally seeing vacancy rates fall again. And so that's a signal that potentially Perth will bottom out sometime later this year. The forecast, though, is still that prices will fall in Perth between 4 to 8% and minus 5 to 9% for Darwin. So it's going to be another down year for those two cities, but this should be it. This should be the final downturn, and then the bottom should come shortly after.
I guess some other trends just to watch out for, Doug. I know you've sort of talked about the changes and the tree changes as another sort of trend to watch. And I guess you'd assume some of those lifestyle areas would benefit from that. But that's sort of those two trends, is that something that you're watching again this year? Definitely. Actually, coincidentally or ironically, the bigger Sydney becomes, the smaller it becomes, because there are numerous multi-billion-dollar infrastructure projects well underway. So we're finding that accessibility is better than it ever has been before in some areas, I hasten to add. So if you were to move out, say, to the Hills District or the Hawkesbury, obviously what with the North West rail link being built, it's far easier to get into the city. We're also seeing an influx of people moving into the Central Coast. They don't necessarily have to have the access to the city because we live in a digital, mobile environment and community. So as long as you've got a laptop and a mobile phone, you can do most things from anywhere, quite frankly. And we're actually seeing not an exodus, but an emerging trend, I think it's fair to say. And then let's look at the government as well. They're very pro-innovation. So I think Sydney, Melbourne and Brisbane are all vying for the title of the sort of start-up and tech capitals of the Southern Hemisphere. Just some very final thoughts. We've just got to wrap up. Louis, your sort of overall, I guess, your main thing that you're watching and you're worried about this year?
A potential interest rate rise earlier than expected. And look, in a way, that might be a good thing because that means the economy is running harder than expected. But, yeah, that would affect the market for sure. So, definitely concerned about Sydney and Melbourne. There is reason for overvaluation in those cities. I mean, the reality is that each of those cities is now expanding by 90 to 100,000 people each and every year. And all those people need properties to live in. So we're less concerned about the oversupply in Melbourne regarding apartments. There's been some numbers that have come out very recently suggesting that developers have actually scaled back. So we don't think there'll be a major oversupply situation of apartments in Melbourne per se this year after all. Brisbane, though, there's still a major issue of oversupply of apartments, particularly in the CBD and 5 kilometres radius of the CBD. There is still an issue there. We're recording vacancy rates in excess of 5% in the CBD itself for Brizzy.
Final thoughts on the year ahead for the property market, Doug?
Well, I echo and concur what Louise just said.
Yep.
In Sydney, I think they're certainly building record numbers of dwellings, but they're the wrong type of dwellings. There are too many apartments being built and not enough detached, affordable houses, I'm afraid.
So it just makes those detached houses even more
Correct.
costly.
Yeah, again, more downward pressure.
Okay, great to have your thoughts, both of you. Thank you so much for joining us. Doug Driscoll, CEO of Starr Partners, Louis Christopher, Founder Managing Director of SQM Research. Thank you both so much.
Thank you.